Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Huge week in the markets today. It's July 29th. Let's take a look at the year-to-date performances. Massive green days pretty much every day this week. S&P down year to date 13.26% now, huge comeback. Nasdaq down 20.71%, Russell down 15.82%, and the Dow Jones down only 9.54% year to date now. All these indexes are still bearish trend. This is a massive bear market rally, which we've kind of expected. It's very possible to get up all the way to Momo on all of these indexes. Our regime model is still saying a 70% chance of risk off. Still highly risk off situation. Leverage is not a good idea right now. Let's look at the calendar for next week. So, August 1st, we've got PMI manufacturing final, ISM manufacturing index, and construction spending. Tuesday, we've got motor vehicle sales and JOLTS. Wednesday, we've got factory orders, ISM services index, and EIA petroleum status report. Thursday, we've got international trade in goods and services, jobless claims, EIA natural gas report, and the Fed balance sheet. Friday, we've got employment situation. So let's dive in to what the market did this week. As you're all probably very aware, had a massive rally. A lot of it was sparked from the FOMC meeting that was on Wednesday last week. Everyone's calling the Fed pivot, right?
Yeah. That's a good one because literally right after the Fed dropped their decision, the market pretty much rallied 3 days in a row here. We closed the week on ES up 3.62%, and on NQ actually it's a bit more. It's it's actually less. I thought it was more. It's 3.28%. So it doesn't. In all, markets are up into the end of the week after the FOMC statement, and everyone is saying, look, risk assets are getting a bid. The Fed is now pivoting. They are no longer going to be as aggressive. We're going to go over all of that a little bit later in the podcast on why the Fed has not pivoted. It's very important.
This rally it's very dangerous because you're also seeing it in bonds. If we take a look at ZN, bonds are also acting like the Fed has pivoted.
Right. We're well off the June lows, right? We're even off the July lows at this point, going into August now. So we're going to be going into August, into the month-end highs, into upper vamp. So there's a lot of things that can happen here. I mean, lower vamp is down at 117s and ZN for TLT for those that want the percentages. Lower vamp's 354 basis points lower from where we are right now. So it's not even. I mean, you want to talk about 350 basis points on bonds, and then you want to leverage that out if you're in TMF. That's 9% swing. Mm-hmm. That is not something that you want to be holding to then figure out after lower vamp blows out in bearish trend and you're getting pushed lower that the trend is wrong and you're taking anywhere from a 15 to 20% gonging on leveraged bonds, which is why
it's very important right now to know the distinction between just price action and short-term movements versus the actual macro trend that you should be on.
Right. And we cover this almost every day, but this is on Twitter. This is the MOVE index, right? So this is bond volatility, and bond volatility in the grand scheme is still extremely elevated. We're back to 2010 peaks, not 2008 and 2009 obviously, but this is right after we had the great financial crisis. Volatility was still very elevated. We're well beyond the peaks all going all the way back to 2013. So this is the highest bond vol environment we've seen in almost 10 years. So this is not where you just want to be throwing money around, especially in leveraged products, which is why we are not in them at the moment. We will be in them when the time is right, but being in them now makes no sense because, again, we will explain to you later, the Fed has not pivoted. We
Yeah.
don't believe so. The market hasn't given us enough definitive direction in that matter either. So it's not like we just have opinions we're pulling out of our ass for some bigger theory. This is just what the market's telling us, and we're gonna go over that later. But let's segue into the important recap of what happened in the most recent week here. So we had the Case-Shiller Home Price Index as of May come in 10 basis points under estimates. But as expected, this was a decline from the prior figure. Remember, this is as of May, by the way. So there's a bit of a lag here.
That's a huge lag.
Yeah, it's a huge lag, I should say, right? We still have June and July to digest before we get to current prices, and we won't get June's data until August, and then July's data until September. So as you can see, this is a lag. You would expect home prices to slide, given that new home sales month over month as of June. So this is 1 month ahead of the Case-Shiller Price Index. They came in 71,000 new homes being built under estimate, and but it was expected to decline from the prior figure, so it's in line with expectations of declining. But as you can see, the what you saw on the Case-Shiller Home Price Index last week, or in the most recent week here, it's most likely going to continue to get worse. 10 basis points lower isn't the low, and 20%. We're still sitting at 20% year over year home growth or home value growth. So that's not that is going to slide, especially given interest rates are up, economy's in the shitter. We'll go over that in a little bit on redefining recession. But let's continue here. So the Conference Board Consumer Confidence as of July came in 1.2 points under estimate, but as expected, this was a decline from the prior figure. So here, this is the major difference that I want to explain between the Conference Board confidence and the Michigan sentiment. So when you hear consumer sentiment and consumer confidence, this is the big difference. So there's the Conference Board of Confidence and the University of Michigan Consumer Sentiment, and they were both released this week. But the Conference Board of Confidence surveys a larger sample, while the Michigan Consumer Sentiment has more detailed questions. So what that basically means is the conference board sends out a survey to more people, while the University of Michigan is only targeting 500 people, and the other one's targeting 3,000. So it's about 6 times less, but they're asking more questions to get more detailed responses based on specific expenditures, so on and so forth. Either or, we came in 1.2 points under estimate, so that came in lower. We also had durable goods month over month as of June come in 220 basis points higher than estimates. This actually also beat estimates with an increase from the prior reading where a decline was expected. So instead of declining, durable goods went up. And then we had goods and trade balances as of June come in at $5.02 billion higher than estimates. But as expected, this was an increase from the prior figure. This is still at multi-year lows, which continues to give the U.S. dollar a bid. Remember, if you're a exporting country, you have a stronger currency. So as we are exporting more than we're importing, and the rate at which we're exporting is higher than where we've been in the past 10 years. So given so, the currency is naturally going to be stronger. And that's what we're seeing with the bid in the dollar. Then we had FOMC come out raising 75 basis points. Again, we'll go over that in more depth shortly. Finally, here we had GDP On an annualized basis, quarter over quarter, this was a prelim for quarter two of 2022, come in at 140 basis points lower than estimates. This also beat estimates with a decrease from the prior reading where an increase was expected. So everyone thought GDP was going to come in increasing from the prior reading, basically saving the market from a recession. Remember, a recession is 2 quarters of negative GDP growth. We got the second quarter this week. We then had the people in Washington come out and try and redefine a recession, because obviously, if you change the definition of a recession, you can't have a recession.
Yeah, it's simple. That's just
It's simple,
that's how it works,
right?
right? You just say
Yeah,
you're
I
not
know.
in a recession, and then
Right.
you don't have a recession.
Exactly. They said that since the labor market is tight, it basically trumps the fact that we had 2 negative quarters of GDP. We also had the GDP price index quarter over quarter for quarter two 2022, the prelim as well, come out at 100 basis points higher than estimates. This also beat estimates with an increase from the prior reading where a decline was expected. So let's sum up the GDP real quick. GDP quarter over quarter, not the price index, regular GDP was expected to increase, while the GDP price index was expected to decline, basically showing you that inflation's slowing, growth's rebounding, a repair of what's going on. The complete opposite happened. Growth came down and the price index went up. So we beat expectations in opposite directions, which is not really what you want to see given the quote unquote Fed pivot, right?
Yeah,
Um,
exactly. And
Go ahead.
we've got so many reasons why this Fed pivot is complete bullshit,
I
and
know. We're going to
I'm
get into
excited
it.
to talk about it.
Yeah, we're going to get into it, but we just got to finish up the few bullet points here. Given the GDP price index, what I just said, that's obviously stagflationary, right? Because you have growth slowing now, but inflation remains elevated. We then had the initial jobless claims as of the prior week of July come in 6,000 claims higher than estimate. But as expected, this was a decrease from the prior figure. Just something to note that jobless claims have yet to actually blow out. This would be a sign that the labor market is not so tight anymore. We've yet to see that. We then had core PCE price index year over year for June come in 10 basis points higher than estimates. This also beat estimates with an increase from the prior reading where an unchanged figure was expected. This is excluding food and energy, and it's still printing new highs for the year. So just remember that. People want to say, oh, energy, the food. No, this is core PCE, so it's not including food and energy, and we're still printing new yearly highs. So that is not going to be good. That's not good for the inflation narrative. And it's funny because Powell actually came out the other day and said that PCE is more reliable than CPI because obviously PCE is lower than CPI. So you got to point to the winning
Yeah,
horse.
you just kind of
Yeah,
you pick and choose the
yeah.
data that favors what you want.
Exactly. Yeah. So that's something to watch here in the next couple of months. So we're going to keep an eye on that. And then we had the employment cost index. Again, this is more of an inflationary talking point, but for quarter two of 2022, it came in 10 basis points higher than estimates, obviously, right? But as expected, this was a decrease from the prior figure. So yes, a decrease from the prior figure, but still beat estimates higher. Um, this still remains at the highest it's been in over a decade, signaling current pressures of employees on corporation. The current pressures of employees on corporations remain strong, and inflation remains sticky. Higher wages are offsets to the consumer by what? By price hikes. So that's what, again, another data point is signaling that corporations are going to continue to hike prices. And then finally, the last bullet point here, we had the University of Michigan consumer sentiment as of July came in 0.4 points higher than estimates. But as expected, this one was an increase from the prior figure. So this bounces expected, and came in zero point 0.4 points higher than where the estimates were. Now, nearly half of the respondents in the survey said inflation is weighing on their personal finances, which was exceeded only once before in 1951. So half the respondents are actually noting that inflation is weighing their personal finances, and this wasn't even reported in the 70s. from the consumer
Wow.
from the University of Michigan consumer sentiment. So it's very interesting to see how people are battling with what we have going on right now, and the fact that a lot of people are noting that it's basically weighing their, you have a company, right? A company has a bottom line. Everybody has a bottom line. You make money, you pay taxes, you have expenses, you have so you have things, liabilities, you have assets. At the end of the day, you have a bottom line. And that bottom line is being affected. Everyone's seen that effect, or most people, from inflation. And people are actually noticing this and saying this now in the survey. So something to watch. Now, it's only 500 people because it's the Mitch Consumer Sentiment. It's not the conference board, but still something to watch.
Yeah, and
So,
that's huge because
yeah,
that's votes
that's
essentially.
votes.
That's
Yeah,
why politicians care about inflation in the first place. They don't give a shit about inflation if it's slow and it just affects everyone over time, over decades, then it's fine. But when people start noticing, that's when they start to care because that's when they start losing votes.
right. And I think that we can all say that it's pretty obvious that the administration now, let's take politics, put politics aside. Let's sit in the middle here. It's obvious that the current administration is very concerned about the fact that the economy is going into a recession and that we have an inflation problem. We
Well, yeah,
have,
it hasn't
we
been
have
seen in so long, right? It's
Right. And we have verbiage coming out of from the White House saying basically jumping up and down and pointing like, "Oh, look, I fixed the gas problem," or "We fixed the gas problem. It's now going down." Um, let's not get into whose fault it is for going up, but let's just talk about the situation we're in, where people are not, where, excuse me, the White House has to, we have midterms coming up here in a few months, and obviously this is like political warfare. It's what this is, where they're going to try and spin whatever they can, and put it in a manner that they can basically put themselves ahead. Why are we defining why are we redefining a recession? Why do that, right? Because they don't want to look bad. It's really that simple.
yeah,
It's not like rocket scientists. They just don't want to look bad. And I understand. I wouldn't want to look bad either. But at the end of the day, the Oxford Dictionary literally says that the definition of a recession is two consecutive quarters of negative GDP growth.
yeah, and
If you want
that's
to,
been the case for ages.
that's been the case since, who knows, going back at least
I
50.
mean,
And I think that's
since
been the
they
case.
started tracking
Yeah, since
GDP, I don't know.
yeah, it's got to be the case since they started tracking GDP. I mean, literally, the definition of a recession is that you are slowing. Now, one quarter, think of it logically, right? One quarter of negative GDP growth, that could be a blip. That could be okay, whatever, right? No big deal. A second quarter, that's a problem, because remember, a quarter is 3 months. So now you're 6 months. You're half a year of negative GDP growth. That's a recession. You're spending half a year in negative growth territory. How is that not a recession?
Yeah, exactly.
I'll tell you how, because the job market is tight. That's what they're going to tell you, but that's not real. That's bullshit.
Yeah.
Um,
Well, okay,
but
so let's talk about the Fed pivot.
yeah, let's talk
Okay,
about that, because
so
that's got a lot of people. That's got a lot of people going this week.
oh
A
yeah,
lot of emotions are chugging along here with the old Powell pump and Powell pivot. So let's
yeah.
let's get into it.
So let's start with defining what the pivot is. What is a Fed pivot? So a Fed pivot is they're doing the exact opposite of what they're doing right now. So right now they're hiking rates. They're going to be continuing to hike rates. The Fed pivot is essentially they come out and say, okay, inflation has peaked, growth is down the shitter, we need to stimulate again. It's time to cut rates. That's the
Right.
pivot. And that's what
And
people are expecting now. Well, not
I think,
everyone, but
yeah,
it
not
seems like
everyone,
most.
obviously.
Seems like
It's it,
most.
it does, but this is a good way to explain what you just said. Is exactly this. The Fed pivot would be the opposite of what they're doing right now. So you see how we have two rate hikes in the next meeting, and then one, and then not even 50%, not even a 50% chance of one rate hike in the December meeting, and then we go into this 50%, 36%, 77% chance of rate cuts.
Yeah.
This would get pushed up, so we'd start to see one one full rate cut here, then here and here. That would be the Fed pivot. That these rate cuts start phasing in, and they don't happen so slowly. It's going to be rather swift because the market is very efficient in pricing things in. So the market's not going to sit here and play games and wait. If the market thinks the Fed is going to pivot, the pivot will start to be reflected in the back end of this curve. We've yet to see that. Going out a year from now, we still don't even have a 100% chance of one rate cut. It's 77%. So you could lean and say, yeah, the odds are higher that this is going to be a rate cut, but we're still not there. And one rate cut, you consider that a Fed pivot? I don't, given the whole fact of where the effective federal funds rate has basically come from. We're doing 3 rate hikes a go right now. One rate cut, and it's nothing.
Yeah, that's not even really a pivot.
Yeah, that's not a pivot. And you can see that with the curve here to illustrate it better for those that want to see this more visually. This is the spot effective federal funds rate, and this is the next meeting, and so on and so forth. So the orange lines are the following meetings. As you can see, the terminal, right? Let's define terminal. Terminal is the peak at which the Federal Reserve policy, or I should say actions, top and either go sideways and reverse from there. So the peak or terminal is 325 basis points.
And the terminal did come down quite a bit
It
in the
did.
last few weeks. It was what,
Three,
3.5, 360?
yeah, yeah,
Not just
360.
not that long ago, right? Like two,
So
3 weeks ago.
we're down 35 basis points. Now, that's about one rate. To be honest with you, that's a rate. What's one rate hike? We're pricing out one rate hike is missing. It's not as crazy as it's come down a bit, but it's only one rate hike that's missing from the terminal right now compared to where we were a few weeks ago. But the most important part is what we did right after the Fed meeting. So this only slid like 10 basis points post FOMC. So Powell's verbiage didn't really affect the terminal too much.
Yeah, but he did have some verbiage of signaling a pivot. What was it? I don't know the exact
Okay.
quote, but he did
What he
say
Yes,
that
yes, I know what you're
they
talking about.
they would cut if they need to, or something
Yes.
along those
Yeah,
lines.
and what really got markets going is he basically said that they're going to take meeting by meeting and go basically be data dependent meeting by meeting, and what that means is they're going to monitor the situation. They don't want to give guidance right now because if inflation shifts, they don't want to put the market into a position of preparing to hike rates when they don't need to. I think that's kind of it's kind of pulling the wool over your eyes because I mean, let's go back to
Well,
ES,
they're
right?
basically they're not being proactive at that point. They're being
Right,
reactive.
but let's just look at it from a weekly chart to get a better understanding. So, coming into the week, ES was pretty much at under 4,000. We're now at 41.33. So ES is under 4,000. If Powell came out and said he's going to have to do more rate hikes and the terminals were mispriced, basically more rate hikes than expected and the terminals were mispriced, um, this would not have happened. This would have gone down greatly,
Yeah.
right? Because remember, the market is going to price out the terminals as it sees fit. Nothing really changed here because nothing of Powell didn't really give any shift in what's going to happen. There was no like shift in guidance or additional like basically saying that we're going to need to be more aggressive with rate hikes. He was basically saying he's going to take it meeting by meeting. And this is my opinion. And I think that so far the market is supporting my opinion. And this is my opinion. I think that Powell saw the situation that's going on in the equity space. Obviously, the market's in the shitter. Okay. And he's thinking that by going meeting to meeting, we could take it as dovish, right? And he's what he did was he anchored on basically the jobs numbers and how the labor market's quote tight, quote unquote, remaining tight. And obviously, we said this the other last week or the week before in the podcast. The labor market's tight until it's not because the labor market snaps and people start getting laid off. So he's basically taking the the idea of a tight labor or the data points from a tight labor market, which unemployment's released, the unemployment rates released monthly. So again, that's lagging. Gotta anchor on some lagging data here,
Yeah.
to really make this fun. So he's anchoring to that lagging data, which is behind the curve, which he himself is behind the curve, but that's beyond the scope of this. So now he's going to look at unemployment, and he's going to say that the labor market remains tight. We have to watch the data points, and we have to be data. We're gonna basically take it meeting by meeting, saying that what he's telling you right to your face is he doesn't want to do too much to screw the market up. So the market's like, oh my God, he's not going to hike to oblivion. Let's go, run, right? Well, what if he told you that to basically pull some fear off the table here, get people lined up for a rally, which I'm thinking is what happened. He's basically telling you he's going meeting to meeting. And I don't think it's meeting to meeting by, oh, inflation's peaking. This is my take. I think he has to tell you it's going meeting to meeting because inflation's not going to abate the way that they want it to. And the basic peak in this federal in the futures here in the forward curve is going to the terminal is going to slide higher. The terminal didn't slide enough lower to indicate that the Fed is done because the terminals will realistically, even if the Fed was glued to hike the next two or three meetings, the terminal would stay the same. But this back end of the curve is not falling apart.
Yeah.
The back end of the curve is not really getting crushed, which is telling you realistically that the market isn't buying that inflation has peaked yet. And we'll even take a look here at the effective federal funds rate. So if you look at the chart here, if you're watching the video, you can see the orange line is the effective federal funds rate. I have a dotted yellow line, which is the terminal, 325 basis points. And this beautiful white line is CPI. Okay?
Yeah. So it's quite the spread between those two.
Just take a look at this. If you look at this, you will see how absurd this looks. The terminal is at 325, but inflation is now at 9.1%. Unless inflation starts putting in negative 2%, declining 2% every month for the next 3 months, I don't see how the terminal is 325 basis points in December. It's about August now. By the time you guys are listening to this, it'll be pretty much August. August is, you have August, September, October, November, December. You have 5 months. You're at 9%. If this is going to fix inflation, inflation best be a lot lower by the time we get here. And as you can see, if you start putting this through your head, it doesn't make too much sense, does it? And I think that in reality, this is, again, my opinion. I don't think Powell could have put the amount of rate hikes needed to cure inflation on the table. There's no way. If he told everyone that he was going to lift, let's take the effective federal funds rate, right? We're pretty much coming from in February of this year. So 6 months in, we were at zero. We're at 233 basis points in 6 months, right?
Yep.
If we did one rate hike, so we got all the way up to, we did 25 basis points in March. We knew this was a problem in March, right? If he came out in March, inflation, I mean, because back in March, inflation was what? Inflation was 8%, right? 7-8%. So if he came out on the table and said that he needs to lift the federal funds rate to 5% in March, that wouldn't have worked well, would it have?
No, that would have just destroyed everything.
That would have destroyed everything, right?
But 5% is likely what they need.
Likely. I mean, that's, again, there's no macro.
Yeah, there's no
model.
science behind this.
Right. There's no science behind the price, the terminal that we're thinking the market needs, but there's a psychological science behind what I'm trying to explain to you guys, because at the end of the day, these speeches, they're written by very educated people. Again, when Powell goes off script, things tend to shift, but when these scripts that Powell reads, which are released prior, by the way, most of them are released, not the FOMC statement, but when he comes out and talks, those scripts are released prior. You can basically see what he's going to say the night before on some of these conversations. And I think that the people who write them, because I don't think it's him, I think the people that write these scripts are very well versed in basically figuring out how to get a point across without actually anyone realizing it, but
Yeah,
still
they're like
saying it.
psychology experts.
Yes, because just let's look back at time here, or in time. Let's put Fed funds rate up. This one didn't update for the most recent pivot, but most recent rate hike. But as you can see, going back in time, inflation above 3% has only been cured by the effective federal funds rate rising above the rate of inflation, and going all the way back to 1955. So I just want everyone listening to realize that this would be the first time. This would be a first time occurrence in over 70 years.
Yeah, like how do you have that wide of a spread, and you
Yeah,
just you cure inflation with 3.25%.
right.
You know,
You're
that's
curing inflation with
10% inflation with 3.25
yeah,
terminal
you're
rate.
not.
There's
You're
no
not.
way.
In my opinion, you're not. And I think that Powell basically is going. I think 325 is going to be higher. And even if, let's just say I'm wrong, 325 is lower, and I'll come out. We'll have a whole conversation when the time comes in the next few months if I'm right or wrong that 325 is not going to be the final terminal. But let's just say I'm wrong. Our bond that would mean that the Fed has pivoted and bonds are a buy. No, doesn't mean the Fed has pivoted because the Fed has not pivoted. Remember, no matter what you think, if 325 is terminal or not, is the final terminal or just a placeholder, I'm on the side of it being a placeholder. But if you believe it's the final, there's still no rate cuts being priced in here. Bonds are still bearish trend. And again, we use futures because they're the most liquid, right? There's no gaps, no bullshit. This is why we run DDAP on the futures for bonds, ZN. It's not it's the 10-year, so you're kind of getting the middle of the curve, the middle of, between the 5s and 30 years, you're getting in the middle, kind of, right? That's what we're doing here.
Yeah.
So that's why we're doing the 10-year. That's why we use the 10-year, because you get pretty much the middle of the curve. So, and long story short, this is bearish trend. This can chop sideways. This can go up to here, up to Momo, come all the way back down. We've said this for many weeks now, not provide any real trade, or I should say powerful swing. When ZN goes bullish trend and the Fed pivots, let's take a look at the last time the Fed pivoted on bonds, which is 2018. That was here. This is the last time the Fed pivoted. Do you see the runway here?
Yeah. And that's what you need. You need
Look,
a rate cut environment to get that kind of move.
right.
We're nowhere near rate cuts.
Yes. This type of runway, think of this like the leg you want to be in. And think of everything in bearish trend back here, where we are right now. This right here, this whole lull area, this is where we are right now. Realize bonds have bouncing, people are excited. Bonds are no higher than where they were in April, right? Now, oh yeah, they're well off the lows. Yeah, okay. They're off the lows in what? In a month and a little over a month? Doesn't mean shit. There's over 300 basis points of downside as of Friday's close on TLT. Just think about that. This thing can swing. It's not like lower vamp is way out, like this thing's grinded, lower vamp's compressed. Bond vol, as I showed you earlier, is the widest it's been in a decade.
Yeah. Like this is very likely to be the biggest bond trap like that we have ever seen.
And something to even talk about. Let's look at the system. The system's actually dropping week over week here. Now, this is the third consecutive week of deflation fading.
Yeah. And deflation, that's where bonds perform.
Yes.
That's where you want to own bonds, and it's going down.
Yes. And guess what? While bonds are going up, would you look at that?
Now that's a disconnect.
So who's going to get played here? Do you think the system's going to get fluked, or the big bond and gold guys are going to get the fluke? I want to lean with the bond and gold guys getting fluked, because the system has no emotion, has no belief. You had people come out and say in the last meeting, I just want to make this clear, 75 basis points, you're an idiot if you think it's going to happen. Literally, that was a tweet from an account. a reputable macro guy, right? He tweeted that. Now, I don't believe it was verbatim, Artie. Do you remember what the verbatim tweet was off
I
the top
mean,
of your head?
it was something along the lines like, if you really think the Fed's gonna raise 75 basis points next meeting, you're a fucking idiot. and
Okay,
and
yeah.
then they raise 75 basis points a
Right.
month later.
Right. Now why? Now why would you say that? Well, you would say that if the biggest downside of investing and basically managing money is being the salesman on yourself. Selling yourself is the number one downfall that I've seen of people who manage money, people that are invested. They get cleaned, okay? They get cleaned doing this. They sell themselves an idea. Now, I'm not saying all these big macro guys are just getting cleaned. That's not what I'm saying. What I'm saying is when you sell yourself an idea on number one, the models that some of these people use, it uses economic data. You could have the best nowcast in the world, but in reality, it's lagging. Okay, by the time you realize it, the data is shifted. Okay, the market's already pricing that in because the market's front running the data you're tracking. Just remember that the market's front running that data, so it's really you have to pay attention to the market, not the data. The data is so we can have a better understanding of what's actually going on, but that's because we're seeing the market act the way it's doing. It's not, oh, I figured out the data, I can run the market. The market's already gone. The market knows more than we do, and the market knows the data before the data even comes out. So just look at the market. That's what what the system is built on. Anyways, the most important thing here is you got people that are selling themselves on an idea, call it the Fed pivot, and they think that because the economy's in a recession, the Fed has to pivot and inflation's going to come down naturally from demand destruction. The market's not telling you that. The forwards on the federal fund rates are not sliding the way that they should. Bonds are just chopping. There's no real definite price move.
Well, I mean,
And then
this move in bonds could easily just be retail, and
yeah,
these macro tourists that don't really know what they're doing buying it up. It's still just
true.
price action. Like
Yeah,
this is not even a long-term trend forming yet.
no, if it was, it would be green. And if it was a long-term trend forming and it was bullish, not only would it be green on DDAP, it would be in our portfolio and we'd be telling you guys that we're long bonds for for the run to the moon. But it's not yet, and it doesn't look like it's going to be right now. I mean, we got deflation regimes falling. Why? Why are they falling if this is supposed to be going to the pivot? The pivot is a Fed pivot, for those that don't know, is basically deflation. What that is. The Fed
Yeah.
pivots in deflation. They don't
Yeah,
pivot any other time.
they're not gonna pivot while we have 10% inflation.
No, and
That's their
something else.
mandate. They have to get that
Yeah,
under control.
something else to watch is actually commodities. We saw we're seeing commodities off lower vamp now back to Momo. Crude was up at 1.5% today. It closed up 228 basis points. Regardless, though, this you're telling me you got commodities going up. So remember the FOMC statement was on the 27th. Commodities have literally risen every single day, or excuse me, every day post FOMC, commodities are up.
Yeah, these commodities are not buying the whole EFFR coming down.
Yeah,
They're not
yeah.
buying it. Commodities
Well,
are so essentially this is kind of the life cycle. This is how it'll work. Commodities going up means we're still in inflation. If we're still in inflation, the Fed will not pivot. If the
oh,
Fed
you mean
doesn't,
stagflation? You mean
yeah,
stagflation?
yeah, sorry, yeah,
Yeah.
stagflation.
Okay.
The Fed will not pivot. If the Fed doesn't pivot, bonds are going to continue going down. The bond trade is not there. That's the
Right.
life cycle. And so that's what we're seeing right now. It's just playing out right now. These macro tourists think the Fed is pivoting. They're buying bonds, but commodities say otherwise. The EFFR says otherwise. Even the yield curve is saying otherwise.
Yeah. You know what's interesting though? The point that you just made. So commodities are going up, right? And the terminal, right? The terminal has went down. but commodities are going up. The terminal is only going to go where the market thinks the Fed is going to go. After the next 2-3 meetings, this kind of gets wishy-washy because I don't think the reason you're not seeing rate cuts in here aggressively is because the market is unsure of what's going to happen with the Fed. But I'm telling you that I really think this 325 basis point terminal is a placeholder, because if the Fed pivot was here, I'll show you what a Fed pivot looks like. Here, you want to go look? Let's look at commodities. What a Fed pivot looks like. It looks like this.
Yeah.
Okay, no, it looks like this. Right here. This is a Fed pivot.
Yeah. We would be seeing that right now in commodities.
Why are these not shitting the bed? It's bearish trend, right? It should shit the bed. But the fact that it's gone straight up after FOMC is telling me, like, okay, no fear. No fear in commodities. No fear in risk assets. And my hunch is Powell's not an idiot. It's almost like, okay, think of it like I said earlier. You're going to tell the market shit's going to hit the fan. Would you rather tell the market vaguely that shit might not hit the fan? More precisely, would you rather tell the market that they're going to do something instead of that something could be hiking or it could be cutting? Tell the market you're going to do something. It makes it look dovish. Market can rally a bit, that you can go back to hiking.
Yeah, and then they have a little bit more cushion to work with. And
exactly.
That's probably what they planned. That's probably totally done on purpose.
Let me tell you, I don't think these people are stupid. As much as incompetent. Let me explain something to you. This transitory thing, I said this earlier. It's people selling themselves something, right? You're this guy Powell. You get on stage. You have to show confidence. You have to show that you know what you're talking about. You're the head of the central bank of the United States. You're the top guy. You're the top dog, as they would say, right? Of the Federal Reserve. And you say inflation's transitory because at the time you believe, okay, listen, inflation will snap back. I mean, let's be honest. You just printed like a quarter of the supply of dollars, but whatever.
Just
ignore
that fact.
Ignore that fact. You think inflation's transitory. Everyone can have an opinion. You come out on stage, you say it a few times, right? You say it 3-4 times. You start to believe it, right? Because again, you're selling yourself. Every time you come out and speak publicly, you have to. These people are trained. They have to speak with confidence. They can't get up there and be shaky, okay? Like her or not, this is not a Nancy Pelosi press conference, okay? This is literally the central bank. This is, when it comes to finance, this is the top dog of America talking to people. This is not, speaker of whatever. This is not some White House interrogation battle. This is the top person of banking in America. He has to come out and speak directly with confidence and understand what he's talking about, because people are going to ask him questions. So if you come out there with confidence and talk about inflation's transitory, even 2 or 3 times, and you start to see it's not transitory, but you still believe it, you're going to defend that point because you still believe it. And once you start defending that point, it's a vicious cycle. It's a very vicious cycle because you go down, you end up defending the point it's almost like if you're in a bad relationship, right? And your significant other cheats on you, right? Take that person back once, right?
Mm-hmm.
If that person does it again, you're not going to feel as hurt because you've already been there. You're going to feel more hurt in yourself, and you're going to be more aggravated, but you're still going to believe. It's a vicious road and a vicious cycle. And that's literally what happens when you sell yourself. That happens with with FinTwit. That happens with the central banks. That happens with you. That happens with me. That happens with everyone. If you sell yourself too long, you end up falling into the trap of not understanding your surroundings. And that's the most important thing when you manage money. Get your emotions out. Leave your emotions at the door because they will only hurt you. There's no point in feeling. The way our portfolio is positioned is I don't care if the thing swings 10, 15% up and down. It's set up that way for a reason because I know the market's volatile. I know that what's going on. VIX is still north of 20, right? The Fed pivot, but VIX can't even get under 20 so far. And last time it was low, right? Last time it was back in April we got all the way down to 18 and then went all the way back up to 35. So this is a bunch of horse shit. If you think that this is done, you think the peak is in, it went bearish trend. That's notable. But it's also, you have to realize that volatility is mean reverting. So as volatility grinds higher and Momo grinds higher, this is going to eventually come down. We are bound to get a 20 VIX again at some point. And given that Momo is so high, yeah, we got a bearish trend. Yes, is it something to watch? Yes, it's something to be like, oh, maybe there's something going on under the surface, right? Sure. But given the environment we're in and all the major indexes are still bearish trend, you have to take everything with a grain of salt when you look at individual things. That's why the system is so important, because this accounts for everything in one easy setup. This is not, if you just look at VIX, you have to now take into a grain of salt that everything's bearish trend. So this bearish trend is less significant. That's what the system's for. It basically weights everything accordingly, right? But let's take a look at VIX, right? So VIX can easily spike. This is not in where the last time the Fed pivoted, VIX shit the bed, literally. Like, let's go back to 2018. Right here into 2018, we had the VIX. This was the Fed pivot. VIX went down, right? And it just went down. Look at that, for months.
Yeah, we'll have to keep an eye on that, see what the
Right.
VIX does over the next few weeks.
Well, just remember this. Why did the VIX collapse? This goes back to everything that we've talked about since day one. Quantitative tightening and quantitative easing, sorry. When you're tightening, you're removing liquidity from the market. So it's very hard for VIX to be to just go into dormant mode. The Fed is still hiking interest rates. The dollar's still strong. There's a lot of things that are going on that financial conditions are likely to still get worse. You think financial conditions have bottomed? Unemployment's still at 3.6%.
Yeah, just wait
So,
till unemployment snaps.
right, you don't think VIX is going to snap again? That's that. So this is me telling you that don't get all junked up. We're still in risk off, and as you guys know, the next probable regime is even worse. It's
Yeah,
deflation. So we have to take everything with a grain of salt, because at the end of the day, it's the entire picture that matters. It's commodities are still up, right? Inflation has not, I mean, let's just say this next inflation reading comes in lower. Okay, how much lower is it going to come? Is it going to come in at 6%? Is it going to come in at 5%?
yeah, no way. There's no
No
way
way.
it reverses that quick. It doesn't.
No, no. But the terminal, though, think of it like the ceiling. This is going to stop here and it's going to, oh, then the Fed pivot. We're going to go all the way back down. That's why it does. You know what? If you look at this on a chart, it makes no sense. Like, I literally am looking at this right now and I'm confused on how the ceiling of the, just, you know what? We're going to bring this back to fundamental, okay? Fundamental, like kindergarten level. We're going to break this down, okay? We're going to go back in time to 1950 real quick. You got the orange line and you got the yellow line, okay? The orange line, I'm not even going to explain to you what each line does because it doesn't matter. The orange line, or what each line is, the orange line goes up when the white line goes up. The orange line usually chases the white line, okay, in certain scenarios. Over time, that's what happens. So, as the white line is ripping, the orange line is following, okay? The orange line has to be above the white line to fix the problem with the white line, okay? Real simple, right?
Yeah.
Every time.
I feel like I'm in kindergarten class right now.
Exactly. So now, if we look at where we are right now, right? The orange line, okay, has to go above the white line, like we said, to fix the problem. The problem is the white line's at 9.1%, and the orange line needs to go up here, but the orange line is capped at right here at 3.25. You see how that's a problem?
Yeah, that doesn't add up.
That doesn't add up.
The white
right?
line essentially has to come down.
Right. The white line, for this to work, by December, the white line needs to be pretty much under 3%.
It needs to come down pretty much 70%.
Yeah, and I don't see that happening, Chief. I don't know about you,
Yeah, that's
but I don't.
that's
I don't
not really
see
how
that.
it works, especially
Yeah.
when you have sticky inflation like we have today.
Yeah, I mean, you got employers just basically we got people hiking the price of their goods at this point. They're just trying to bake inflation in, but the economy is slowing. So they're basically just this is the problem. Inflation is going to keep compounding until there's real demand destruction. But how do you get demand destruction with unemployment the way it is? And this goes back to what we've been saying. We said this the other week. Think of it like a seesaw, right? The Federal Reserve's job is they have two mandates: maximum employment and price stability. Now, if anyone has taken an economics course, even in high school, you would know what the Phillips curve is. And I should have explained this from the get-go, but I wasn't thinking about this, and that's my fault because you guys probably you could have had a better understanding off the jump if I just explained it this way. So we're going to bring up a Phillips curve, and I'm going to show you guys how this doesn't make any sense with where unemployment is today.
And it's literally
It
like
okay,
it's kind of like physics. It's like the laws of physics.
right.
This is just
So
how it works, and this does not change.
right. Yeah, this is like gravity, right? Many have tried to jump and defy it, but they end up just hitting the pavement. So like it's just, you know, simple. Wage inflation on the left, we'll call it inflation, right? And unemployment rate on excuse me, on the wage inflation or inflation on the y-axis and unemployment on the x-axis. This is what's called a Phillips curve, okay? As the unemployment rate rises, the rate of inflation drops. This is demand destruction. As unemployment rate falls and stays low, inflation can run because there's more demand because everyone's got a job or everyone's working. There's a supply of demand. There's no shortage of demand because everyone has capital from working.
Yeah, everyone's got money to spend.
Right. This, I want you to picture this: unemployment and basically inflation. This is where we are right now in inflation. And let's see if we can pull up the unemployment rate. And we'll take off yeah, you know what? Can we pull both together? There we go. Right? So they have to come in opposite directions. They're going to move in opposite directions. See, in COVID, one, unemployment went up, inflation goes down.
Yep, and it happens pretty quick
Here,
most of the
here,
time.
back in 2008, unemployment rips, inflation goes down. So this it needs to go up substantially, right? To cure this. The last time we had inflation this high, okay, the unemployment rate was, you don't want to believe, it's 8%.
Jeez.
We're, we're at 3. So remember the Phillips curve right here, right? Remember this. The Federal Reserve has to break one side of the equation to fix the other. And they always are going to try and find the equilibrium where everything makes sense. Unemployment's just about right, and inflation's just about right. So what am I telling you? Am I really being that cynical? Yes, the Federal Reserve is going to have people lose their jobs.
Yeah, that's
It's fucked up, but
there's
that's the
no
truth.
there's literally no way around it. It's like gravity.
Right. It's
That's
gravity.
what needs to happen.
Literally, the unemployment rate needs to come up enough to the point where inflation then they cross again. This is going to cross again at some point. This is going to revert over time. Okay, well, we're going to play another kindergarten game. Let's look over time, right? Over time, over time, the orange line likes to be on top of the white line. And if the white line is on top of the orange line, there is some issue. Look back at 1970s, we had the runaway inflation. The orange line was chasing the tails of the white line, okay? And as the white line collapsed, the orange line basically went up. Okay, as the white line collapsed here, the orange line went up. More so in 80 when the Federal Reserve really let interest rates fly because they pivoted too early last time.
Mm-hmm.
right? They pivoted too early when employment was at 8%. Employment went all the way up to like 10, but inflation went up to 15 pretty much. So just remember that inflation's at 8 right now, unemployment's at 3. You want the Fed pivot? What Fed pivot? This ain't no Fed pivot.
It just can't happen. It
The white
literally
line,
cannot happen.
long story short, the orange line likes to be on top of the white line. So what does that have to tell you? That has to tell you we need to do one of these little inversions, right? There we go. We need this. We need to invert. We need to invert the situation. Orange above white. So inflation needs to come down, but the only way inflation really comes down is by unemployment really ripping. So, how do you break the labor market? You know how you do it? You just keep hiking interest rates until something breaks. It's
Yep.
kind of like a screw with a screwdriver. The screwdriver's in there, right? Or the screw's in there, but like the thing's still loose. So what do? You just keep screwing. Just keep stripping the screw until you have no screw left. That's literally what's going to happen here. They're going to strip this down to where unemployment starts accelerating. This soft landing, this is why a soft landing is impossible, right? How do you have a or it's highly unlikely, because to have a soft landing, you would have to have unemployment rate just tick up nice and slow to let like just look at the rate climbs of unemployment. When is it like a gradual? It's a gradual decline. When's it a gradual climb? Here, in 1988, or in between the late 80s, early 90s. All the other times it's a rapid
It's usually
ascent.
elevator up, staircase down.
Right. So how do you have a soft landing? I really would like to have to figure out
Well,
how the Federal Reserve.
I'm sure they know that a soft landing is not possible.
And I'm sure. I mean, listen. You want to talk about odds? There is definitely there's a probability out there for a soft landing. I just don't think the Federal Reserve is capable at hitting that probability, just because of the way that they are. They're already playing games with rate hikes right now. Like they have to play game. They're trying their best to do the soft landing. They're in my opinion, they're putting the placeholder terminal, right, to get the market in their mind. Market bounces, okay, market's up. They can play some games. Market comes down. Market doesn't really crash though. Soft landing, ha ha ha. Everyone runs home, but like that's not how it's going to work when unemployment rate starts ripping. Because at the end of the day, that's what's going to need to happen to fight inflation. So if that's not happened yet, how is the Fed? The Fed pivots when the orange line is up. Remember that. The Fed pivot happens when the orange line is elevated. Okay? Or or the orange line pretty much, well, I should say the orange line is elevated. Yes, because even back in 1980s when the Fed pivoted in right in the mid 80s, the unemployment still rose, but inflation kind of fell off a cliff. But that rise was from 7%. We're at 3%. Literally, we don't spend much time at 3%.
Yeah, definitely not.
So, so the fact that we're here and we have a impending, and I'm not gonna even say that we have a recession on the table. This impending bullshit. We have a recession confirmed now.
Well, yeah, it's
Literally,
confirmed. Yeah.
literally by definition, it is confirmed. There's no more bullshit. We have a inflationary recession. An inflationary recession is what we call the common folk stagflation. Okay, it's part of the life cycle of the economy. Expansion, inflation, peak, stagflation, death, deflation, and then back in again, circle of life. This is not like a taboo event. This is going to happen over and over again, over years, over cycles. This is normal. So we have an inflationary recession, and I think that that's where we can leave it off today, and we can pick up this next week with a whole new slew of data and more talking points, hopefully, from based on any shifts in the effective federal funds rate or interest rates themselves. Thank you, everyone, for listening. Have a great start to your week. If you have any questions, feel free to reach out to us at www.market-radar.com or reach us at our Twitter at the marketradar.com. At the market radar, and you can find the link to our Discord on our website, and everything's free. You can come in, talk to us, see what we have to say, ask us questions in real time, all free of charge. Thank you so much for listening. Till next time.